Welcome to IMG Insights, our video series that explores topics within multifamily real estate investing. Today, we're talking with Investors Management Group founder and CEO Neil Schimmel and Principal Co-President and COO Karlin Conklin. I'm Dave Mikkelsen, Director of Investor Relations, and I'll be moderating the conversation. To begin 2025, we're seeing divergent tracks develop between the stock market and investment real estate. The stock market is going through historic volatility. An example is the S&P reaching a high in February and declining since then. Real estate, on the other hand, and especially multifamily, is quietly regaining strength after a cycle downturn. In this session, we'll talk about the balance through cycles and what it means in a diversified investment approach. So let's start by taking a look at recent headlines in the financial news. We've got the stock market on a roller coaster with up and downs every day. Meanwhile, real estate is slower and steadier and appears to be on a track of recovery. Karlin, how are you digesting the recent news?
There's great volatility in the market, and you'll see that at least in the stock market itself, volatility every day, announcements every day about things are going up, they're going down. And you can see that in some of the headlines in front of you right now. The one that I find most interesting is CNN Business, and they talk about the fear and the greed index. And what's driving much of the volatility in the stock market right now is fear and uncertainty. There's also uncertainty in real estate or even in multifamily, which we are experts, and you'll see some of those headlines. But what we also see is, and what we also believe, is that a lot of the uncertainty is behind us, whether it's interest rates, or its delivery of new product, or its jobs. And so while we see a recovery coming on with multifamily, we do not see that for the stock market in the short term.
Great. And Neil, if we kind of dig down and look at the NASDAQ composite as an example, just looking at the last year, it shows the volatility that Karlin mentioned. What would you point out here?
We are all feeling the volatility. The current policymakers haven't really given us a predictable path, and it's been such a short term that they've been there. It's a change of a whole paradigm that we've been used to for many years. That volatility shows itself in tariffs, in inflation, in possibly a recession. Many of our investors, to Karlin's point, are really at the stage of their lives where fear is what's prevalent in their investments or their decisions. We're looking at a time right now where many of our investors are in their latter years looking for more predictability, and when they look at their 401k or their other liquid investments that are stock related, it's very hard to predict how all of these external factors are going to affect that stock. With real estate, you have some control. You can make some predictions as to, what is going to happen with rents. What's going to happen with interest rates? Is it a good piece of real estate? It's tangible. So we're seeing a lot of fear in our clientele. We see them looking for more safe homes for their money. And we find that the stock market right now, although a very important component of somebody's investment strategy, as compared to real estate, which they're both important vehicles, right now we see a much more predictable path for real estate.
Great perspective, Neil, and that's a good transition to talking about real estate, the real estate cycle, and the impacts that drive value. Karlin, here's a look back at the last about 25 years of real estate values and multifamily. What's your perspective on the drivers here?
So there are cycles in both stocks and in real estate itself. But what is important about this particular chart is to see that the cycles in real estate are longer and further apart. So we see a big drop in the Great Recession after the financial meltdown of 2008. We also saw, when we get into the balance of 2021, early 2022, what we saw was great increase in values in real estate, because all of a sudden financing was very easy and it was very cheap. And you saw coming out of the recession exuberance. And then after the interest rates began to rise, what you see is a real drop in values in 2023 into 2024, simply as an adjusting period from those externalities. And what we're also seeing is the baseline at about where we are right now is at the zero baseline. And this is giving us a lot of confidence in the fact that the jarring between 2020 and 2024, that's kind of a 4-year cycle versus a 4-day cycle in the stock market. What you're seeing now is that we are slowly moving into a growth phase again. But externalities absolutely affect multifamily real estate like they do the stock market. It's just a lot longer period of time where people and the product can adjust accordingly.
Yeah, and thanks for explaining that. I'm going to pick up on a phrase that you used, and that's moving into a growth cycle. Neil, you're always tracking construction deliveries and supply and demand. What's your read on the driver with the supply and demand that we've been working through over the last few years?
I'm on the road a lot in a lot of the cities that we operate. There is a lot of supply. It'll be pocket by pocket in the market, but when we go and we see it, it does have a profound effect on the entire ecosystem of apartments. That being said, as you look at Atlanta, which is an apartment-driven market, you can see how grand the deliveries have been and how they are just going to essentially fall off the cliff going forward. There are a lot of projects that are not going to be happening. And as a result, with the absorption that we've seen, which has been very strong, toward the end of the year, we believe that that inflection point between demand and supply will start to find their balance. Right now, we see concessions in the market and low rents, and we believe by the end of the year, that trend will start to change in modest gains. And going forward, with the lack of deliveries that we're going to be seeing, it will certainly firm up the better markets and give us an opportunity to really take advantage of a longer term predictable growth pattern in the apartment market.
That's excellent. And you're right. This example of Atlanta is kind of a reflection of what we're seeing across the country with supply tapering down, and I think some traction that we're getting with occupancy and rents that we're hoping starts to appear later this year and into 2026. Well, Karlin, we've talked about stocks and multifamily cycles. How do we tie these themes together if we're looking for balance in our investment strategy?
First of all, there are many different things that people can invest in other than real estate or stocks. But because those tend to be, with our investors, the primary investment tools that they use, we're focused on that today with this presentation. And if you look at the comparison and some of the factors between stocks and multifamily real estate, several items are most pronounced. First of all, in looking at your portfolio and in looking how you want to invest, first thing to look at is risk management and diversification. What is your tolerance for risk? And how long are you going to be investing in either the stocks or the real estate? You want to look at that, and also diversification. Many of our investors, for their diversification, they're simply placing money still in real estate, but in various markets so that one market can balance the other. Others put their money both in stocks and in real estate itself, but diversification for any investor is an important tool. Secondly, return potential. Whether it is the highs and lows of the quarterly reports, for example, in the stock market, whether it is a particular market that there is a piece of real estate and all of a sudden a huge influx of people and jobs, such as San Antonio, what is the return of that real estate? But it's going to be long-term versus a stock market. And finally, it's liquidity. What we all know is stocks, you can cash out fast. Real estate is different. And so with real estate, your liquidity is a longer term perspective. And for example, even today, if someone was feeling very risk averse and they wanted to put their cash, say, I don't know, in gold or in the freezer. The fact is they could cash out of their stock very quickly. Real estate today, the market in general is very low in transactions. So trying to sell out a person's real estate today, whether it's a home or it's a multifamily, a large multifamily property or an office building, is going to take time. So when you consider risk management, return potential, and liquidity, there's difference in both of these investment tools, but they balance each other out very well.
Nicely recapped. Well, thank you, Neil and Karlin, for sharing your experience. This concludes our presentation. Tune in to our website for more IMG Insights episodes on demand.